Good afternoon, everyone. Today is Tuesday, February 20th, and we're going to do another live trading session. But before we do that, we're going to talk about something that's pretty important. It's a little tweak to the UOTS strategy. That I announced kind of yesterday, and I want to go over that to make sure that everybody understands exactly what changes. It's not a huge change or anything. It's a small change, but it's pretty important, and I want you to understand where it's coming from and what it'll do for us, and how we're gonna go about it. Basically, the main changes in the delta of our naked put. So as you know, the current trading plan calls for a default of 8 delta, and we can go up or down, generally up to 9 if needed. And that was the default position. Everything was based off of that. And then with that, we do a 75 wide, 2 of the 75 wide in MES, put debit spreads in MES against one ES naked, which translates to one put debit spread against 5 MES naked puts. It would be the same ratio. So this is fine, everything is good, and this is performing very well as it is. But I want to improve a little bit specifically for to keep the notional exposure under control. What happened over time, I used to trade options on equities, not the futures on equities, and I'm used to trading higher deltas, 15, 20, sometimes 30, that doesn't matter, all kinds of different deltas. But then once I switched to futures some time ago, I guess I got a little bit what do you just call attracted by the nice premium at a lower delta against your buying power usage because of the way the span margin is calculated. So it's an allure that got me in a little bit too far away, because you can see here on an 8 delta for 38, or let's say call 4,000 in buying power, you're collecting around 1,000. So as you can see, that's close to 25% of the of your buying power, return on your buying power. So if you look at for example, SPY or any equity, if you do the same thing, it's not nearly as attractive. So you can see right here, what you get less than a couple hundred bucks for about the same buying power usage. So that's nowhere near as attractive, and normally you would just go higher, and that's how it is. However, in futures, it's not like that, and I got a little bit spoiled with a high premium, and I was trading comfortably in that neighborhood under 10 delta, 8, 9 delta, and that's fine. However, this also means that we are exposed, as far as notional value, we are more exposed, which is not a good thing in case that the market turns down, and especially if it turns down suddenly and we have any type of black swan event, or even just a large pullback or a correction. We want to minimize the notional value exposure. And given that my main goal, number one goal, is do no harm, I'm more concerned with not hurting the account than I am with making large returns. So with that in mind, I'm trying to reduce the notional value while keeping the the profits and the returns in the same area. And we're going to take a look at an example here, and I'm not even saying that this is the final outcome. This is the current playbook that we're going to be doing. And basically what it is, let me just go back to here. So instead of doing the 8 delta, we're going to go, so 8 or 9 delta, we're going to go to 11 to 12 delta, which is about three deltas higher, and we'll collect more premium, probably on an average around 30% more premium. And this will then mean that we need to have less open trades at any given time. So if you take a look here at the platform, just as an example, and we go to 8 delta, let's round it. This is around 1,000. Doesn't matter. It's around 1,000 bucks that we collect in premium at 8 delta. Then if you go to 11 to 12 delta, we're talking about 13. It could be a little bit higher, 30, but 30% more on average. Doesn't have to be exact. But what that does is it allows us. Let's say that we want to collect any given premium in order to reach our goals, and let's say that for that we need I don't know, say 5,000. 5,000. We need to sell 5,000 in premium. So if we do 5,000 and do 8 delta, we would need, let's do 4,000. I'm sorry, just to make the numbers easier to digest. Okay, let's say we need 4,000. If we do 8 delta, we're gonna need 4 naked puts. It's that simple. However, if you take 4,000 and divide it by 1,300 instead, you get something in the pretty close to three naked puts. Might not be exact, but 3.1 or 2, that doesn't matter, 3. So as you can see, this is a reduction of 25%. 4 minus 25% gives you 3. So by doing this, we're not changing the amount of premium we're collecting overall, and we are reducing the notional exposure by 25%, which will come in handy in case of a pullback. We'll have 3 naked puts that are hurting us instead of 4, and we'll have 3 naked puts that we're trying to defend with any hedge that we might be doing instead of 4. So that's a huge advantage that might not be easily seen when the markets are calm, but it will be apparent when the markets are pulling back. Obviously, everything there is a little bit of a trade-off. But in this particular case, I've tested it many different ways. There is not a huge difference in win rate. It's minimal over the long term. The difference in winning rate, maybe it's 1% roughly, assuming the same stop loss and profit take. And what was I going to say? Bottom line is there is not much difference in the premium that we collect. However, we had 75% wide put debit spreads kind of going with this premium that we sold here. So since we are selling more naked premium per each naked put that we're selling, that means that we have a larger potential stop loss when that naked put is challenged. So we need a little bit more protection on the other side as well. And to keep the ratio same and keep our under 20%, like we're trying to do, spend under 20% for put debit spreads, we're going to move this to 100, keeping the delta still up to 35. It can go somewhere under 35 if there's no 35 delta available. If it's 33 or 32 or 34, doesn't matter. But keep it somewhere between 30 and 35 for our long put, and then go 100 wide as a default. Obviously, it will vary based on available strikes and DTs and whatnot. But as a general default, it'll be 100 wide. Actually, 200 wides for one ES. Now, one thing that I want to mention as well is that this changes the dynamic a little bit when it comes to frequency of trading, because if we sell one naked put in ES at 1,000, that will cover us for a certain amount of days. Let's call it 5 days, right? If we now sell the same one put, but we collect 1,300, well, this is now covering us for a little bit more, let's say 7 to 8 days. So all else being equal, we would have a smaller frequency of trading. So instead of putting trade once per week, if I don't change anything, I would be putting trade every 10 days, roughly, if you count the weekends. And that's not something I really want to do. I really want to stay under at a weekly or under trading schedule. So I think what I'll be doing now until the account grows a little bit, and I think I'll be just moving a little bit more money to the account from some different investments just to grow account a little bit to go back to ES. But until that is done, I'll probably just go with 5 MES. MESs with let me just get somebody in the room. 5 MESs with 1 PDS attached to it. So that might be a trade that will keep me in a frequency of under a week. So before we go there, is there any questions while we're on the whiteboard and we can address any questions? Please tell me. No? So I'll assume this is kind of clear what the explanation was good enough. Okay, so let's take a look at what the platform is giving us today. And before we do that, let's just take a look at the numbers today. So today's the 20th, and the VIX is at 1534, and our deltas are delta 77 and 32, 77 and 32. And our buying power usage is, just a second. Okay, let's refresh this. So 15.4, 15.4. Net lick is 54,949. And we are ready to put on another trade. So let's take a look at, and remember last time I had a fat finger and I put both of them in ES. This time we'll make sure that we are in the correct place. So we're going with the ES, and remember the trading plan calls for naked puts at 90 days plus. So I don't really want to go under 90 days, but at the same time, I don't really want to go over 120 or even 115. So with MESs, there are a little bit less strikes available often, and that means that sometimes we have a situation like this. And in this case, when it's like this, I will go with 87. 120 is just a little bit too far. So 87 is still fine, and maybe in a few days we'll move to the next strike. So if we go here and we go to right here and maybe take a look at what open interest is here, just to see if there is any reason to move away from one of the strikes. Here we're getting 128, and then let's not forget that we want to do 5 of them. So let's go to 12 right here and collect 687 if we can get filled here. So let's do that. We might go down slightly. Let's go to activity. This one is working. Replace. Go down. Okay, this is gonna fill now. So in order to spend less, up to 20%, we just basically, since this is a ratio 5 to 1, basically if we just spend the same amount for one of the put debit spreads, will be at 20%. And given that we just collected the 27, we just need to make sure that we stay under that. So if we go here, 34 would be interesting, and then we go 100 down, and we have even a little bit extra. So it's fine to spend a little bit less, so long as we get our 100 wide. So we'll just keep it here. We'll probably have to up it a little bit just to get it close. Let's do that. And then it's done. So we're gonna record this, and then we'll see what's next. So let's go to naked put, and we'll call this 46. And here we have to make sure that it's now MES and today's date. The strike was, let's open this, 45.50. 45.50. It was 87 days, and we got what was it, 27.25. I'll double check, but I think that's what it was. 5, and so that's it. 27.25, yes. And then we got PDS at 49.25. we go to PDS, and that was a 49.25 and 48.25. It was 87, and let's call it a 47 MES, today's date, and we well, let's say we paid 22.50, so minus 22.50, and we did one of those. All right, so this is now in the books, and if we now go back to our main tab, you can see here that it picked up the new premium that we just did, because you see nothing changes here. The fact that we changed the delta a little bit changes nothing here. We're still doing 20% allocation. We're still calculating everything the same. So we the only thing is I was testing something here because I'm thinking this is the yearly hedge allocation. For right now, it's still 5, but I'm thinking of experimenting a little bit with a VIX ladder, and I was thinking maybe allocating a few extra percentage points to that, but I'll let you know when that starts. So for right now, as you can see here, it got me a next trade on Friday. So in 3 days, obviously, because we collected less. And just to show you what would have happened if, let's say, if this was, I'll return it back. But let's say if we actually collected the full amount, which was what, 13, let's say, just call it 13.5. What would happen is it would give me the next trade on Thursday, the 29th. So that's 9 days from now, and that's just too far apart. And I understand that I'm missing out a little bit because of the the fees and commissions being higher, and maybe slippage and whatnot on MES is being a little bit worse. But that's fine. I don't want that to distract me from my main purpose of scheduling properly and doing the proper allocations so that I don't overextend myself just in order to save a couple bucks on the premium. So yeah, ideally ES would be better, but we just need to grow the account a little bit to do that. In the meantime, we'll do this, and this allows us then to do a little bit more trading. So I will see you again on Friday. And by the way, for all of you watching, if you find this useful, make sure you like it and subscribe. And if you want to participate in our live trading sessions and the mastermind meetings, make sure you join our Discord. The link is in the description below. Last Friday, we had a very nice Discord session, mastermind session. It was really good. And I think we'll do one this Friday as well. We'll need to talk about a topic, but we'll do that in the Discord later on. All right, I think I covered everything, guys. Is there anything? Let me see. Somebody can I ask a quick question. Surav, yeah, Surav, go ahead, please.
Uh, yeah, so I was thinking a couple thing, right? So one was like I think yeah, I like the tweak, right? Selling around 11 delta for the naked puts,
Mm-hmm.
and I I I, I think this another maybe we can. What do you think of this? Like we keep the put debit spread as is, like before, but
Mm-hmm.
we're definitely collecting more premium. So how about using that for shorter dated long puts, right? And that can also give extra protection.
Yes,
Uh,
I know what you mean. The let me tell you what my thoughts are around that. Basically, what you're saying, and you correct me if I'm wrong. Let me just see that I'm here. Where is my thing? Just a second. Okay, so right now what we collect 100% of something, whatever it is. Then we use
mhm,
20% for put debit spread, and
mhm,
then we use, let's say, 3% on our long puts or whatever
mhm,
hedging you want to do, right?
mhm.
And what you're suggesting is to maybe, instead of doing here, let's say, let's call it this ends up being 15%, and then you change this allocation to 8, for example, right?
For example, our put debit spread it's like 75 wide, right? Like 50, and I think the suggestion is to make it 100 wide because we are collecting extra premium. Um,
Yes.
so I was thinking instead of doing that. we keep where it used to
I
be, the
understand.
put date.
But I think that's we're talking about the same thing. I just use percentages. Like for example, you are
Okay.
saying this: if we collected $1,000 on the naked put premium, we used to spend $200 on the naked put on the put average spread, because that's how much the 75 would cost on an average. And now with this, let's say we collected 1,300, and now we get 100. I'm sorry, 100, because here
Well,
we are collecting 260, and this put is more expensive than, I mean, this put debit spread is more expensive because it's wider. I want you to keep in mind that we're not spending this, and we're not making this wider for no reason. We're spending, we're making this wider because now we have 1,300 in open premium instead of 1,000. So when the market pulls back, this we have 1,300 that's going up in value instead of 1,000. So we are getting hurt more per, which is normal. We are getting hurt more per naked put than we used to. But if we keep the 75, that means we are not increasing our well, we call it protection or whatever you want to call it, per that put. So we would be getting hurt more. Now, I understand that the naked put here would provide some protection, but this is a different kind of protection than this one. That's one thing. And this one here is not going to help us on those small grind down moves that this is designed to help with. This long put will help on a big down move. That's one thing. And the other thing is, if you recall from the trading plan and from everything, this put debit spread, unlike hedging, I don't consider this to be sunk cost or something that we just spend and never get back. This I do. Whatever hedging allocation we put here, I consider it a cost of doing business, and I don't expect to get it back unless there is a major event, which may or may not happen anytime soon. So basically, we don't count on this. This I count on regularly getting this this back to. Let me just show you. If I run any kind of back test with the put debit spread that we're doing, we will generally see this, and it goes like this, continuously goes down, then it goes up in couple of short weeks like this, then it goes up, I mean goes down again, maybe further, then it goes up, and then continues to do that, you know, for years. So if you take a look at this line, let's say break even line, we continuously pop up and down and back up over the line. So I don't consider this what we spend on these put debit spreads, I don't consider that to be sunk money, because sooner or later, so long as we do it continuously and then we don't miss these instances when it goes up, I don't consider it wasted money, and therefore I don't consider it in the PCR premium capture rate calculation. And as you remember, the premium capture rate takes into consideration the win rate, and you know, how much we lose when we lose, how much we win when we win, and then what percentage of the occasions we will win and we will lose, and that's how we come up with our 26, 27 PCR. But this is not part of that, because I don't count that as permanently lost. Does that help?
yes, yes, makes sense.
Yeah. Now, that doesn't mean we can't allocate more money to this hedging purpose. And to help us with that, this is what I'm tinkering with, just so you guys know, and I'll talk about it a little bit more later. Right now, the situation is like this. If we say, okay, let's say you're targeting a 20% CAGR as per the spreadsheet right here. I'm targeting 20, right? And then if I add 5% for yearly hedge allocation, this weekly target premium will jump proportionally. It'll jump same thing for this yearly hedge allocation as it will for my target. And I'll show you an example. So if I put 0 here, if you can see this weekly target, it's 783. And if I double this, if I put 20, which would be double, this amount here will double. So that means that in order to accommodate whatever hedging we put here, we are taking on an equal risk as if we were targeting another 5% or another 10%, whatever the number is here. So there would be no difference in putting 5 here or putting, let's say, 25 here and then removing here. This is the way the formulas are working. As you can see, it will change right here. So you can see 978. And if I go back to 20 and then go back to 5, 978. So there's no difference, right? But that means that we're putting the same amount because the same calculation is used to get this CAGR is the same calculation is used to get this amount added on so we can spend it on hedges. And I don't like that specifically anymore like that. I want to tweak it a little bit. And the reason is because we start chasing our tail, we are increasing our risk too much in order to get this yearly allocation. So the way it is right now, the formula works off of whatever PCR we have in that cell up there. And right now it's 27. But what I'm going to change is I'm going to change the allocation for the yearly allocation just for that portion. So the CAGR portion will still be calculated with the 27 PCR, and it will calculate the premium needed based on that. But the hedge allocation will not count this PCR. We're not going to count the stop losses into that formula. So we're going to be left with 100 that we collect initially. And let's say, let me just use round numbers, even though they might not be 100% correct. Let's say that we have a 60% our profit take. So anytime we win, we collect 600. And out of that 600, we're going to take 200 for put debit spreads. So we're going to be left with 400. So every time we do this, assuming there is no stop loss, we'll get 400. So this would mean that for this purpose, but just for this purpose, the PCR is actually 40%, not 27. So the hedge allocation of the spreadsheet will use the 40% instead of 27, which means that we are encouraged a little bit more to add allocation to switch this, because I want to encourage us to switch this ratio from just this versus this being equal. I want to incentivize us to put a little bit more on hedge without adding equal amount of risk. And I know this has been a little bit now long and heavy, but the bottom line is I want to not add as much risk for the yearly allocation for hedge as I would for the CAGR. And the reason being is because in those instances when there is a stop loss triggered, this yearly hedge allocation that we use for hedging will kick in and will kind of pay for itself, but will carry a little bit less risk around. Does that make sense, what I kind of went over now with the spreadsheet and this calculation?
Yeah, it makes sense to me. Thank you,
Okay,
Victor.
that's very good. Okay. Right, and I'll be working with that. It's not going to be huge change, but what will happen is instead of maybe targeting 978 here, we'll be targeting 900 roughly, which doesn't mean doesn't look like a lot, but over time it means we have less premium open, less naked puts going on, less risk in the account, and we're going to continue looking for ways to lessen the notional value, notional exposure any way we can. We want to lower this amount here, whichever way we can. All right, guys. If there's no more questions, I will see you on all on Friday, February 23rd, around the same time. And then we'll see, maybe we'll do this and then go into a mastermind session right after this. Have a fantastic day, everyone, and I'll see you Friday. Thanks.